Welcome back to the Scaling Up podcast. Today's episode we could call Buying Easy, Holding is Hard, right? The last two episodes, we've talked about what to kind of get ready or look forward to when you're buying a property and what to do kind of the first week or two. Now we're going to talk about holding that property longer term. I think this is something that doesn't get talked about a lot. And in today's market, like almost every course that's out there or most of the information that's out there is just on getting that property bought, how to underwrite it, how to get a deal, what to look for, how to finance it. Really, buying it is the easy part. Like your broker will help you with stuff, your lawyer will help you with stuff. Getting the little bit of money to buy the property usually isn't the issue. Where I think a lot of new investors will get in trouble is long term when you're holding that property. A lot of the stuff you're buying when you're starting out, it's going to be 40 or 50 years old, and some of the stuff might have been renovated, but there's really depending on what you're buying. But even if you buy a building that was built in 2000, now that roof is 25 years old, so you're going to be paying a lot for that building, and you might have a huge expense coming up. And it always kind of amazes me because CMHC is so strict on certain things like where your down payment comes from, and they want to make sure you have the capital to buy the building. But it really seems like there's like no guardrails on if you have the money to actually hold that building, right? Like if you needed $1 million down to buy a property and you could show you had it, you're allowed to buy that property. But what happens if there's $500,000 of work that come up in the next couple of years? Where does that come from? So we're going to talk about a couple things. The one thing that always will happen in the first year of owning it is the large amount of turnover. So the last property we took over, I think we turned over about 40% of the units within the first year. There was just bad tenants in there and a tenant base that needed to be turned over. So now just play that out on whatever kind of building you're looking at, right? On an 8-unit building, that's not a big deal. If you're buying a 100-unit property, that's 30 or 40 units that are turning over. And now you're going into a building, again, that might be 30, 40, 50 years old. And you have to somewhat budget what that's going to cost, right? If you have to turn over 40 units, most of the time you want to be getting better tenants in there. You're going to do renovations. That can be a huge cost, right? It might be $10,000 a unit. Townhomes, it could be a lot more. You could get it down to a couple thousand if you just have to throw paint on and get it leased up. But that's still a huge expense that I just don't think people are looking at that. Not even just in the first year, but over the first 5 years, right? You're going to get units back that haven't been touched for, a lot of buildings will still have 20 or 30-year tenants in there. And that there's no way you can re-rent that into the market today without doing full renovations. So making sure that you don't just have the down payment, but you have a big enough budget. And what changed my thinking on this a lot too was taking over, we bought from a couple different companies now that are huge, way bigger than us, thousands of units, and in one case, 10,000 units. And when you look at kind of how they view it, right? When you get a building inspection report, they have 10 years of CapEx. In their books, that money is getting spent, right? That if they say $500,000 over the next 10 years, they'll usually, be willing to even lower the purchase price by a certain amount of that because they think they're going to have to spend that to hold that building. And I think as new investors, a lot of times that gets missed. Like when you read that on the report, I don't think in your head you're budgeting to have $500,000 or $800,000 sitting there over the next 10 years. And when you're leveraged really highly, that money isn't necessarily going to come from cash flow. Some of it can, but you're not going to have huge amounts of extra cash flow for sure if you're raising capital and paying out dividends, things like that. And so I'm going to use a couple examples of just things that have came up in our properties when we bought them that we really, I wouldn't have expected. And luckily we were in a good spot where it wasn't a huge issue. I've talked about it before, but the first property we bought was one where we took a VTB, we had to put very little money in. And that one, basically everything did go wrong. The boiler went, we had a water tank go, it just was endless. And that was a huge expense. And that's why it made us kind of a bit more cautious going forward. But some of the other stuff where, you can't really underwrite for was on the last purchase we bought. It's townhomes, and we're having a big issue with the garbage in the city of Edmonton right now because they changed they're trying to get everyone to recycle more, so they cut back the size of our garbage bins by about half, and then they pick them up half as often. So, you imagine there's probably 300 tenants at our one property, and now they're being asked to use a quarter of the garbage that they were and just recycle more. It's completely unrealistic. It doesn't work. The city won't listen. They have no interest in trying to fix it. They just say you're allotted the correct amount. So something like that, we've spent this year so far probably around $15,000 just on extra garbage pickups. And we can't go into the bin and actually dump it, but we'll hire another company to come and pick up all the bigger stuff and all the bags that are around there. And that doesn't include any of our employees' time. So if you're looking at a pro forma, that wasn't an expense that we were expecting to pay, right? And little things like that can change. Just little policies, or like not long ago here in Alberta, or in Edmonton, they implemented a thing where you had to put backflow valves on. Well, you still can buy a lot of buildings that won't have them. And, on a bigger townhome or apartment complex, you might have 10 buildings or 10 of those that need to be put in, or 20. And that they're very expensive. That's, the last quote when we were buying a building, we looked and it didn't have it. And the quote for that was, I think, $50,000 to $60,000, which we were able to get the purchase price down. But then you still have to have the money to actually do that later on. But those are things where you just can't, I would never underwrite for that. And if we held the building, if we were already holding it and that change came in, we would have had to come up with $50,000 or $60,000, right? And it wouldn't have came from cash flow. This was just kind of more of something I thought was absolutely ridiculous and kind of funny that came up. One of our properties is outside of the city, and it gets the garbage gets picked up by a private company, and we got a ticket or a fine because there was contamination in the recycling bin, and so they'll always send a video of it. And I was watching this, I'm like, I can't figure out what is in there. Like, everything looked correct. There were blue bags, nothing looked outside of the ordinary. And so they called and they said it was because the recycling bags had been tied shut and they needed to remain open. So, we got 2 weeks in a row, we got $400 fines because the tenants tied the garbage bag shut. And something like that, you just, it's completely ridiculous, but it's just kind of out of nowhere that stuff like that pops up, and it's not something you can really plan for. So problems like that, when it's kind of unrealistic and you wouldn't see coming, there's not a lot you can do to prevent it. That's just communicating with the tenants and saying, hey, here's the situation. We're going to start getting fined. If someone sees somebody else putting a bag in that's tied, it's going to be an issue. So that stuff you can't really plan for. But overall, I think you just need to plan for things like that to happen. Plan for tenants, trashing your unit and you having to go in and spend $10,000 or $20,000 on it. So when you're buying a property, I do think it's important you look at the age of it. And again, if it's 50 years old, take that building inspection report. But that's still going to be pretty cosmetic the way they do it. They're not digging into a lot of stuff. But look at it and really, run that out and say, if we have to spend $500,000 or maybe it's $100,000 on a smaller property over the next 10 years, you need to make sure you have that money, right? Or maybe you talk to your investors if you're raising capital and you say, look, for the first year or 2 years, we're expecting there to be really high turnover. We're going to have to put all this money back in. So we're not going to pay a distribution out. And you can set it up in a way where, maybe you pay the distribution out at year 3 and it can accumulate, or you can figure out a way to do it. But maybe you don't, if you really don't have the cash when you're buying the building, or you just have enough cash to buy it, you probably want to keep as much cash inside the company for the first year or two, just to compensate for all those unexpected things. And if it sits there and you don't use it, then you can pay it out in year 3. But that would be an option too, where you could go to your investors, or if you're buying it yourself. That's why I always tell people, buy the first couple, try to keep, your income or a job, and buy the real estate on the side so that you don't have to be pulling money out to live on it because of all of these things, because you need to keep money inside of there. And I think it's important to note, like when you're starting out, how important it is to look out, 5 or 10 years, because that is the difference in making money and not. You're not going to make a ton of money in 1 to 2 years on real estate. You need to be able to hold it 5 or 10. And if you're just starting to make money and then you have these huge expenses come up, it's not going to that's not going to work, right? And there's good things that can happen too. That can be the exact opposite of that. We just had a tax assessment get lowered by $13,000. So one thing that I think you can do too is if you go and you look out and you say, hey, within 1 to 3 years, we're going to have to spend this money. If there's any way possible to raise that money at the beginning and actually spend it at the beginning, right? If you know that you're going to have to change your boiler or your hot water tank or, change the glycol out in the lines, whatever that's going to be, if you can do that right at the beginning, you're going to save money on the operating side right away. So it's going to actually help you out, and you're not going to have to worry about, keeping cash flow to do it. And it also shows the tenants that you care, right? It's nice if you know you're going to have to do a project within the first couple of years. If you can come in and do it right away in that first year or first couple months, it does let the tenants know that you didn't just buy this building and are trying to suck everything out. If you're a long-term holder and you want to spend the money on it, that's what I've seen from buying from a lot of these bigger companies. They don't look at this as, hey, we're going to buy this and sell it in 10 years. Like the company we're buying from right now, in the last 35 years, I think has sold 4 buildings. Like they just buy and hold. So you kind of know when you go to buy from them, they didn't look at this and weren't trying to like just cheap out on everything and try to, limp it along till a sale. They were looking at this to hold it for 40 or 50 years. So they spent the money. They did the roofs and the bigger stuff. And those are the properties that we always target is I want, an institution or almost that level of person to have owned it. They've spent the big expensive money, the roofs, the boilers, windows, doors, things like that. And then we can come in and do the little cosmetic stuff that doesn't cost near as much. So in the last couple episodes, we talked about what to look for when you're going to buy a building, what the turnover or the transition looks like the first week or two. This episode was more long-term, things that can come up. It's always going to be things you don't expect. It can be good and bad. So I think, build a budget in, a big enough budget that you're covering all the known things that are going to come up and even double it, right? And then you'd be in a comfortable spot. And if you're holding extra cash, it's never going to be a bad thing. You really only lose money in real estate if you run out of time or you run out of money. If you can hold the property long term, it's generally going to go up in value. But you have to have that staying power, right? And withstand all the bad things that come. So I think for sure in today's market where cash flows, it's probably getting tighter. Interest rates are still fairly high. There's signs that we might be coming into a recession. Make sure you have cash on hand. That would be the advice I'd give. I think having a big enough reserve to cover the stuff that comes up, you'll never regret that, and you can always pay it back out later on when you have the property stabilized. So that's it for today's episode. Thanks for listening. We'll see you guys soon.